So last session we were talking about a covered call. And with the covered call, you don't really get downside protection. You can lose quite a bit. What you gain is whatever gain you have on the call. So remember, you're receiving, because you're selling the call, you're receiving $4.30. So when the stock price really falls, you get to keep that $4.30. It's always going to reduce your losses, but that's the most it can reduce your losses. However, as the stock price rises, because you sold this call, you're now losing this amount. And this amount is exactly offset by the gain on the stock. So what that means is the most you can make is $8.07. So what is that $8.07? Well, once you hit $47.50, you're going to start losing dollar for dollar. But you exactly offset what the stock makes. So after $47.50, the gains on your stock are offset by losses on the call. But the difference between the $47.50 and the $43.73 is $3.77. So $3.77 plus your call option is $8.07. That's the most you can make, because between $43.73 and $47.50, you can make $3.77. That's the most you can make. Once you hit $47.50, you're going to start losing money on this call. You always get to keep the $4.30, but the call itself is going to start losing dollar for dollar everything you're gaining on the stock. So the most you can make on this covered call is $8.07, which is the difference between the strike and the starting price of when you enter this transaction, and then plus your option premium. Remember, since you're selling the option, you get the lower amount. Very easy to remember. If you're selling an option, you get the bid. If you're buying an option, you get the ask. Or just remember, when you're selling, get the lower price. When you're buying, you have to pay the higher price. When we graph this versus the underlying stock, it's not going to look all that wonderful as a transaction. So I'll do the graph, but you're going to say, why wouldn't everyone ever do this? So here's the underlying stock, but here's your covered call. The covered call, you still lose money, but you can't make much. All right, so we'll have to say, why in the world? So there is a scenario where this does make some sense to me. Let me put it up here at the top so we can see it. So the covered call versus the stock. So in this case, let's put the stock price in there so you can see it. So the first one, in this case, the first one's the covered call, and the second one is the stock. Let's move these down again. I wish Bill Gates would make that the default. I don't know anyone that wants to have the axis in the middle of everything else. All right, so there's the graph. So why in the world would you ever do this? So the only time I can really think of doing this transaction, we'll go back to the class notes to talk through this because it's in the class notes. So we've done a covered call. So you own the stock, but you sell a call. And your gain is going to be the exact same formula for the calls we've always used, except for you're going to subtract it instead of adding it. So you notice we're subtracting the call premium, but now we're subtracting the call premium. So that means the call premium is a positive for us here. What we lose is when the stock price goes above the strike price. So why would you do that? Let's say you have a target price on Nike of $140. So you say, hey, if Nike hits $140, we're going to sell it. Well, you can wait until Nike hits $140 and sell it, or you can today do a covered call and do a strike at $140. If you do this, if Nike goes to $140 and you sell at $140, that's all you get. You're going to get that $140. But if you do it this way, and let's say Nike's call option is $5, you sell the call option today with a strike at $140, you get the $5. If Nike never makes it to $140, then you still have Nike stock. Maybe got it to $138, so maybe you bought it at $110, and it got up to 138, so you have that gain, but it never makes it to 140. Well, at least with the covered call, you sold the covered call at $5. So if Nike goes to 138, you've got the 138 plus you got an extra $5. You've got to, you make an extra $5. If Nike does make it to $140, you're going to sell it at 140 anyway. This way, when it hits 140, that's the most you can make, just like that's the most you'll make here if you sell it at 140, but you get to keep the $5 call option. So in my opinion, covered call is a good way to execute. If you have a strong target price on a stock, you really believe if it hits that target price you're going to sell, then in that case I would say, hey, do a covered call, go in and execute on your opinion now. You get to keep the call premium, and it's a great way to execute. Some people do that with puts as well, selling puts. There's a lot of strategies for doing this. A lot of firms do it, and it can add a little bit of return, but you do have to have a very definite call target price for your stock. All right, let's go to the next one, which is a long straddle or strangle. We're actually going to be doing a strangle. Straddles are very hard to do because it's hard, as we saw with Snap, it's really hard to find stocks that are right at the money. Most of them are slightly out of the money one way or the other. But here, there is no underlying stock. You don't own the stock. And here, you're only going long. So you buy a put and you buy a call. All right? So if we set this up, I'm going to set it up as a strangle. And so let's try it with Apple. Haven't done Apple stock. So Apple stock price. And I can't remember, boy, it's been moving around so much. So let's go to Yahoo Finance and let's find Apple. And again, it gave me the wrong stock. I don't know why it keeps doing that to me. I know I'm typing all the letters. So 282.97. So what we have to do is a call. We need a strike. We need a bid. We need an ask. Since we're buying the put, we know we're going to be using the ask. The maturity. And then we'll do a put. We need the exact same thing, a strike, the bid, and the ask. So what strike call do we want to do? So we usually want to be out of the money. So let's try 290 for the strike. And so see, if this was a straddle, you would be exactly at the money, 282.97, or as close as you can get. With the put, we also want to be out of money. Let's try 270. So we'll have to go look for these. Let's put Apple. Let's go to options. And again, we'll go out to, again, let's try January 2021. In our purposes, we'll have to use the same maturity so I can do the intrinsic value at the end. So 290 on the call. So let's look at Apple at 290, and there's the bid ask. I can't remember those numbers, so I'm going to copy them in. 28.55. 28.55 and 29.30. And then on the strike at 270 for the put. $270, there's our out of the money puts. 27.45 and 28.25. And so at expiration, Apple is, let's take it down to 200. Let's add 20. Well, we'll see if I like that or not. No, let's add 10. Go up to 350. That's good enough. And so I'm not going to do the actual stock this time. There's no reason to do the stock in this case. So I'm just going to do the call, gain, and loss. Did I do the formula on the cover? Let me do the formulas over here. No, I did the formula, so we're good. All right, so for the strangle, we got the call, and we need to have the put. The formulas are going to be exactly the same as we've done before, and we own both of these, so we use the same formula we've always had. For the call, you just do equal max. The call, the stock price minus the strike, comma 0. So in this case, obviously, that call's worth 0, but we subtract the call price. Remember here, we're buying both of them, so we're going to be using the ask on both. So we're going to lose that call premium. But as the stock goes up, we'll make money on the upside. I'm probably going to have to use a wider range here, but we'll see. All right, so that's the formula. You see how we're using this formula over and over again. And then for the put, exact same thing, equal max, except for here we start with the strike, just what we always have, minus the current stock price, comma 0. In this case, since the stock price fell, we have a gain of $70, right? $270, a strike, and the stock's trading for $200. All we got to do is subtract out the premium. And so there's our gain on the put. And on the put we have a gain, and then the most we can lose is our put premiums. Just like on the call, the most we can lose is the call premium. The most we can lose on the put is the put premium. But it's the exact same formula. You know, the only difference is I keep switching whether I start with the strike or the stock price. So there's the call, there's the put, and now we have the strangle. And the strangle is nothing more than add these two together. Very, very, very simple. If we graph it, it's not going to look like anything at all like we've been doing. It's going to, if it's a straddle, a perfect straddle, it would look like the letter V. With the strangle, it would not quite be a V. It'll have a floor to it, so look more maybe like a U. But let's graph it so we can see it. And I do need to go further. I need to start lower and go higher. So I'm going to start at 150, and I'm going to go much, much, much higher. Let's go to 400. I want to give you a really good shape to this chart. So you notice with the strangle, you lose a lot of money if the stock price doesn't move much. And that's the key with a strangle. The strangle and a straddle, you're betting on a large change in stock price. You're hoping the stock moves a bunch. So you can see here, it looks almost, I guess it looks more like a V than a U, but it still has a floor to it. A straddle would be exactly a V. So this is a strangle. I'll put the underlying stock prices in here, make it a little bit more understandable. And here we don't need the legend because there's only one thing here. Again, we got to fix Bill Gates' problem here. All right. So there's our strangle. So if the stock price doesn't move much, we lose money. You can notice we lose money for quite a wide range. We're only going to start making money down here. You can figure out where we start making money, because you think about it, we've paid a lot of money. We paid $29.30 for the call. We paid $28.25 for the put. So to make money on the downside, you've got to make, it's got to be below 270. It's got to drop below 270 by both the put option and the call option. So it's got to get down to 212.45. So 212.45 is going to be your break even. On the call side, we've got to get up to 290 plus we got to make back the call premium plus we have to make back the put premium. So at 347.55, that's going to be our break even. So this stock has got to move a bunch. So if you think about this, 250, the stock has to go up 24% for you to make money, or it's going to have to fall quite a bit to make money. So so here's how much it has to go up to make money. The stock has to go up 23% for you to make money. Now remember, this is a very long-term strangle. I went out to January 2021. Most strangles, you did your paper 2 on the earnings announcement, and most strangles and straddles are done or very short-term, like 2 weeks or a month or less, and they're done around earnings announcements. So if I'd done this much shorter term, it would have been much cheaper. And so if you do it around earnings announcements, then your goal is to take advantage of the large stock price when earnings are announced. But remember, options are priced very efficiently, so they already have that captured in the pricing, so it's already there. Right, we only have one last thing to do, and that's called a collar. A collar. So there's the long strangle and the straddle. We've done that. A collar is very simple because we've already done it. A collar is essentially a protected put and a covered call. So essentially you buy the stock, you buy the put, you sell the call. And you might try to make it zero cost by buying a put that is the exact same price as the call you're selling, and that way you offset the two. So let's try this. What I'm going to do with this is, just to save a little bit of time, is I'm going to go back to our covered call that we did. I'm going to copy that over for our collar. And so what we're going to do is we've got the call. So that's already set up. Remember, we sold the call. So what we're going to do is we're going to do a put option with a strike. Again, out of the money, let's do a strike, say at $40. And we got to get the bid, ask, and the maturity. We'll do the bid, ask, and maturity. We'll do the maturity the exact same place we did it. So let's go back to Exxon. And we got to find that 2021, the same one we did before. We'll go down to puts for $40 on the puts. 545 and 610. So we've already got the covered calls, so all we have to do in here is we can just insert a column, and we're going to have the put gain or loss. So the call's already set up, so that the put gain or loss, hopefully you'll become an expert of this. It's max the strike, the strike minus the current stock price, comma 0. So you will make money there, minus stock the option price and the ask price. Remember, for the call we used the bid price because we were selling the call. Here we're buying the put, so that gives us our gain, and there we make $40 minus 25, $15 minus the 6 cents would make $8.90. So I'll put that formula up there, the same formula we've been using. So if you're not getting it yet, then you're missing something, because we're just doing the same thing over and over again. So hopefully if you practice it, you'll start figuring out what exactly we're doing here. So here we have the collar. So on the collar we take the stock plus the put minus the call. And when we graph that against the stock, you're going to see a very strange looking graph. I don't know what to call it. It's a collar. So you have this little area where you move the stock. When the stock price rises a bunch, you're capped at your gain, but when the stock price falls, you lock in a max loss, so you don't have any more than that. So this is the collar, and we put the stock price in there. You can kind of see it's sized up pretty well. So that's the collar, and that's the stock. Now, why would you do this? The times I've heard people do this, it's someone who's owned the stock for a long, long time. Maybe they've worked for this company for a long time. They were an executive, and they have all these stock. They have this huge allocation to the stock of the company. Maybe they worked for Exxon for years and years, and they bought shares of stocks in their 401k plan. They don't want to sell because it's going to generate all these tax gains, but they're worried about the stock selling off, and so they want to lock in the bottom. So essentially, this is a way to kind of hold on to the stock tax efficiently. I've done collars at UTSA. If this range is wide enough, it's not too bad of a strategy. If you only do it 1 month out, you can capture a lot of gains and losses a lot of gains of the market while still having downside protection at the bottom. All right, so that is it for options. And so I'm going to save this, and I'll put this file out there on Blackboard. Then what I'll do is, what we're going to do in our last class is exam 2 review. So we'll go through the entire exam from the last class, from last semester, and you'll remember that because we've been working those as team questions. So you'll have some practice. We'll also do a team question at the beginning of that last class on options, so you get some practice on that as well. So we'll see it twice. Actually, the team question, I'll give you the team question, and then I'll work it in class as the exam review. So we're getting close to the end here. So this is your last video on option and the last video on our class other than the exam review.